Hi, everybody. This is Stock Chart of the Day, David Skarica. So I'm going to get right into it here. So thank you for everyone who's come here from Palisade Radio. I got quite a number of people joining the YouTube page. I really appreciate that. So I hope you enjoy this. I'm going to have some juniors I like, or talk about kind of my sponsor companies. Um, which, by the way, I also put my money. Like, I only take sponsor companies that I like. I'm not just blindly taking money from companies. We'll talk about that next week. Kind of year preview. So one thing I noticed. So like I talked about, the theme of um that interview was essentially was basically oh, sorry, that's my edit page. So I was that I was kind of bullish on gold stocks, and to take this right now, I was bullish on gold stocks, and this is kind of what they could do, in the Fed loosening cycle, et cetera, et cetera. And I was also kind of saying that because the way the market is trading into the rate cuts, it looks to me like you know, it's a normal bull market rate cut cycle. It's not like going to be like 2001, 2002. And for those of you who are new, if you scroll through my stock chart of the day page, or you go to Addicted Profits here and scroll through all these videos, you'll see I have a few videos on the difference between the way stocks act into rate cut cycles and bear markets and bull markets. So anyhow, but what I want to talk about in this is I did read one of the comments. Someone talked about Credit Suisse being a warning sign last year. Fair enough, so what could derail this market? So there's two things I could see. But here's my argument gets kind of counter to Credit Suisse is that there was really no contagion from Credit Suisse. It wasn't like, when they bailed out a Bear Stearns, you could see the problems of the other Wall Street banks. Like this was Credit Suisse and this is Deutsche Bank. It's actually at like near 52-week highs and multi-year highs. So there was like no, like I said, contagion. There was no, oh, Credit Suisse is going down, then other European banks started tumbling. And, that happened last March. We're 10 months beyond that. So probably there would have been some contagion right now. Now, the two things I can see derailing the market are regional banks. So this is the regional bank index. But even that, you can see it's come up nicely after the big decline it had last spring. And the issue that regional banks had is a lot of them took on a lot of debt when money was cheap back in 2020, 2021, and loaned it out, obviously. But they took on cheap debt, but they also had cheap loans. Like they were taking on debt at a couple percent and loaning out mortgages at whatever 3 or 4%. Well, now they can't. Now they don't really have the capital to take advantage of the higher rates, and of course, there's not as much demand. But also the problem they have is in depositors, and I'm sure you're one of them. If you're watching this, you want something in your savings account. The rates are 5%, and because they're not getting this interest, income from the loans that they did during the time when rates were cheap, they can't really afford the cash flow to, pay out higher rates. So there's been a lot of moving out of deposits. And of course, when you move out of deposits and, in a fractional banking system, most companies, most banks have, $1 deposits controlling $10 of assets. So you lose 10% of your assets are insolvent, right? So that's the issue. So if the regional banks, which kind of closed this gap down, which happened last spring, if they go down. Now, let me state that a rate cut cycle is good for the regional banks, because then all of a sudden there's less demand for the higher rates on deposits. If rates eventually go to 3-4%, people won't look for those higher deposit rates, understanding that rates have come down. So that will help them. Because what's been happening, a lot of these regional banks, a lot of people will just say, hey, excuse me, I'll move this money into a brokerage account, whatever, JP Morgan, or, even if you're Interactive, and then I'll just buy a CD or buy a short-term bond and get 5%, because the savings account in my regional bank is only like, it's gone from 0 to 2, that's kind of what's happened. So regional banks having problems. Obviously, if real estate were to roll over, that would hurt them. Corporate real estate actually would kind of be the third one, but I'm not going to get into that. I'm just looking at like these other things. And then the other thing is, in terms of the market structure, is quite simply sentiment. Sentiment is really, really gotten bullish. So this is the Ridex ratio. which takes the amount of bull funds compared to bear funds in these Ridex group of funds. So you can see during the decline in 2022, this ratio went up, meaning people got more into bear funds. You can see that assets in the bear funds moved higher, and people got also more into money market funds. You can see, and then out of the bull funds. Well, you can see they've gotten kind of back into the bull funds in the last year, and kind of out of the money market and bear funds. So this ratio is getting back to the 21 levels, right? It's not quite there, but so people are getting more bullish, and this is the AAII, which you can see in early 2021. Now, granted, sentiment's not a perfect indicator. You can see the peak sentiment in bulls reached in 2021. The market still continued to rally for the rest of the year. So, but anyhow, you can see we got near the peak kind of bullish sentiment that we saw in 2021. So, if everyone's in the market and are too bullish, that could cause the market to sort of decline as well, right? So, like this negative sentiment, you can see 2022, these bear to bull ratios were some of the highest bearish ratios we've ever seen. And that was actually a sign why we did see quite a significant bottom. But again, this is not a perfect ratio. In late 2020 and early 2021, this reached, and the market kept rallying. This is April, and the market kept rallying to the end of the year. So, and I'm only looking at this being a short-term bull market if it is a bull market. I'm not looking at a 5, 6, 7-year bull market. I'm looking at this being kind of like this, I've talked this in the past, a 66 to 68 bull market. Again, for the new listeners from Palisades, you can go look at just a video I did from a few days ago where I talked about this. So, this bullish sentiment can mean that, yeah, we could rally into the election still, and that might be the top then, but these are the kind of warning signs. So I think the issues with regional banks and just sentiment being over bullish, those are things that could derail the market. So that's it for stock chart of the day today, Thursday. So tomorrow I'm going to have news from one of our companies on Friday. I'm doing my New Year's resolution, getting back into shape. So I'm going to start doing my some of the videos from the beach again, my walks on the beach. So I'll probably be doing that one from the beach. So everybody take care. And I hope, again, the new kind of subscribers to the channel enjoy this. And yeah, those are my two kind of like, because I'm always open to all scenarios happening. I still kind of remain, bullish. I do think that, we could continue to see a pullback here because the market was so overbought and sentiment did get so bullish for the short term. But those would be my two warning signs. That sentiment did get pretty bullish on this rally. And, there are underlying issues, on top of just deposits, there's issues with corporate real estate, et cetera, at the regional banks. So those are kind of my warning signs. So I hope everybody's good, and I hope you're all having a good start to the year.